Welcome back to Investing Talk podcast. Today we're looking at Nebius Group. The big question is it a good time to buy now? We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Nebius Group, ticker NBIS. We are looking at a pure play AI infrastructure provider. And the velocity of their strategic moves, just over the past 3 months has been, really something, almost parabolic.
It really has. It feels like an absolute sprint. And, the momentum signaled early, didn't it? Back in August 2025, that's when Nebius raised its annual recurring revenue guidance, the ARR guidance for the year.
Exactly.
That move basically told the market, look, internally, management saw a much bigger opportunity unfolding than they'd even forecast before.
And they didn't wait around. They moved swiftly to, capitalize on that confidence. Yeah. By September, they were already rolling out a major international expansion.
The partnerships.
Yeah, crucial new partnerships with Avreed and Uber, committing, $375 million toward transportation tech and specialized AI deployment.
That's a big chunk of change.
It is, but it wasn't just a reckless gamble, right? They are expanding this on a pretty solid asset foundation, currently valued around $3.5 billion. So there's substance there.
Okay, that makes sense. But the real pivot, I think, the moment that sort of changed the whole conversation for Nebius, that came in October.
Definitely.
That massive external validation from Microsoft. Microsoft announced that staggering $33 billion investment into new AI centers. And Nebius, Nebius secured $19.4 billion of that commitment.
Yeah, that number is just... it's huge. And it really needs some context, doesn't it?
It does.
Because this isn't just, a large purchase order. This is Microsoft basically outsourcing a major piece of their next-gen AI infrastructure, their whole stack.
So it validates Nebius's approach.
Completely. It validates their specific full-stack model, over-relying on maybe more traditional segmented vendors.
Right. It's like an instant boost to their credibility. And they didn't stop there, did they? They also cemented that position with the partnership with TD-SYNX in October.
That's right, focusing on distribution and cloud integration, adding another layer.
Okay, so you have all these catalysts hitting one after another.
And the market responded immediately. Following those October announcements, the stock just surged 9.39%.
Wow.
Which reflects, intense analyst and investor enthusiasm. People are excited about these sustained growth prospects.
Okay, that excitement clearly shows the market believes the growth story. But, excitement alone, it doesn't pay the bills.
That's the crux of it.
If we connect this to the bigger picture, we really need to look at how long Nebius can keep up this hyper-speed growth without, falling off the financial tightrope they seem to be walking.
That tightrope is the central theme here. Absolutely. Yeah. On the bull side, you can't deny the top-line growth. It's explosive.
Okay, give us the numbers.
Q2 2025 revenue hit $105.1 million. That's a kind of mind-boggling 625% year-over-year increase.
625%, okay.
And crucially, their forecast for the 2025 annual run rate revenue, they've bumped it up. It's now between $900 million and $1.1 billion.
$1 billion run rate, that's massive. But, and here's the essential caution, right? The part that has to go with those numbers.
The other side of the coin.
Despite that incredible surge in sales, the company is still posting substantial losses. The net loss for Q2 2025, $91.5 million.
Right.
That's the cost of building the kingdom, isn't it?
Exactly. That loss is a direct result of the heavy capital investment needed to scale this global infrastructure, which naturally leads us straight to their financing strategy. Very aggressive.
Okay, wait, let's pause on that strategy for a sec. They raised $2 billion in convertible senior notes.
Yep.
Executed a $1 billion public stock offering, and then tacked on another $1 billion in notes earlier this year.
Yep.
That's, $4 billion in new capital?
Very quickly.
It is. That just sounds inherently risky for a company that isn't profitable yet. What's the bear case just on that debt load and the dilution alone?
You're hitting the absolute crucial point there. That financing strategy, it has this heavy dual consequence. On one side, yes, it provides the fuel, the capital they need to realize their massive goal, which is aiming for 1 gigawatt of cloud infrastructure capacity globally.
1 gigawatt. Can you put that scale into perspective for us?
Sure. Think of it like this. 1 gigawatt is roughly the capacity needed to power a small city, a small metropolitan area.
Okay, so they're aiming really high.
They're positioning themselves as a true hyperscale competitor, no question.
So the goal kind of justifies the risk, but only if they execute perfectly.
Exactly, if they execute. But then there's the other side of that dual consequence.
Yes.
Increased leverage, obviously, more debt on the books, and significant shareholder dilution from that stock offering and the convertible notes.
Meaning existing shareholders own smaller pieces of the pie.
Precisely.
Yeah.
And the company's carrying more debt. It's a risk balance.
And this complexity, it makes looking at the margin data really tricky, doesn't it?
Extremely tricky. You have to look with extreme skepticism. You might see some reports floating around mentioning trailing 12 months or TTM, net margin of, get this, 98%.
98%. How is that possible given the losses you just mentioned?
It isn't operationally. That number is, frankly, financially misleading if you're trying to gauge current health.
So why is it misleading? What is it actually tracking then?
It's likely a ghost number. It almost certainly reflects some kind of one-time financial event, maybe a past major asset sale or a big tax benefit or some accounting adjustment, something that happened outside of their core day-to-day operations.
Got it. So not sustainable profit.
Not at all. That 98% margin figure, it's basically irrelevant when you're assessing the current financial health. It just reminds us that we have to focus on the actual operating cash flow and those recurring quarterly losses.
Right. So operational profitability remains the single biggest question mark for NBIS.
Without a doubt.
Okay, absolutely. So let's pivot a bit then. Let's look at what they're actually building with all this money. What defines their competitive advantage right now, their moat?
Well, their moat is really based on integration. Nebius is building out a full-stack AI infrastructure platform.
Full stack meaning?
Meaning, we're not just talking about renting out data center space. We're talking massive purpose-built GPU clusters. We're talking the proprietary cloud platform needed to run them effectively, and the developer tools that are necessary for these really complex AI workloads.
So they own the whole vertical for their clients.
That's the idea, from the silicon up to the software layer.
And as we discussed earlier, that Microsoft partnership is kind of the ultimate validator for this high cost but potentially high reward approach.
It really is.
It's hard to see a competitor just easily replicating that capital-intensive infrastructure and landing a partnership of that sheer magnitude quickly.
Very difficult. That deal really is the high watermark for their current moat. It sets them apart.
Okay. Now, let's maybe talk about the technical view for a minute, because with this kind of story, hypergrowth paired with hyper risk, volatility must be huge.
Oh, it's inherent. Absolutely expected. If you just glance at the 52-week range for the stock, it spans from $17.39
Wow, okay.
all the way up to $141.10.
That is a massive swing.
It is. And it confirms the stock is definitely riding a strong bullish trend overall, even though, yes, it did see about a 20% pullback recently, which isn't unusual after such a run-up.
So for those of you, tracking the charts day to day, what are the key technical levels to watch right now?
Good question. The key area of support seems to be forming near that $115 to $120 zone. If it breaks below that convincingly, well, that could signal a deeper correction might be underway.
And on the upside?
On the upside, the resistance is clearly at that recent high, around $141. If they can break strongly above that level, that would signal renewed, full upward momentum, likely driven by these catalysts we've been discussing.
Okay. And the market isn't just going to sit still waiting, right? There are specific events coming up soon.
That's right. We have some very specific near-term events, potential catalysts coming up just in the next 3 months. The first big data point is the Q3 earnings release. That's scheduled for November 7th, 2025.
And that's crucial for?
It'll be crucial for gauging those margin trends we talked so much about. Are the operational losses starting to stabilize, or are they maybe even accelerating as they scale? And what's the updated guidance?
Okay, very important date. What else?
Then shortly after, on November 18th, 2025, we have the S&P Technology ETF rebalancing.
Ah, the index rebalancing. Why does that matter here?
Well, these events often cause heightened, sometimes sudden volatility, and it could change Nebius's concentration, its weighting in major index products like tech ETFs. That could draw new institutional attention, positive or negative.
Right, flow dynamics.
Exactly. And then finally, looking a bit further out, the institutional buy window opens on January 12th, 2026.
Explain that one.
Well, this date is often critical because it marks when a whole host of major institutional funds, think pension funds, large mutual funds, can formally begin initiating or maybe expanding large positions according to their mandate.
And big institutional buying is always a needle mover for high-growth stocks like this.
Always.
Okay, so those are the confirmed calendar dates. But beyond that, we also have to mention the constant market noise, right? The rumors.
Oh, yeah. There are definitely speculative rumors swirling around that could potentially move the stock on their own, even though, let's be clear, they remain unconfirmed.
Like what? What are people speculating about?
Well, one persistent rumor suggests Nebius might be considering spinning off its cloud segment entirely.
Interesting. What's the logic there?
The logic, supposedly, is that separating the potentially more profitable mature cloud business from the high-burn infrastructure build-out. Well, that could unlock significant shareholder value, create two more focused companies.
Okay, makes sense. Anything else?
We've also heard some, again, unconfirmed, reports about Nebius maybe discussing a potential AI joint venture, perhaps with a major Asian technology player.
Which would dramatically expand their geographical reach, obviously.
Exactly. And of course, you always have the ever-present acquisition chatter surrounding a company like this.
M&A speculation?
Yeah, persistent rumors suggesting some major U.S. tech giant is maybe eyeing Nebius, looking to quickly buy their way into a stronger AI infrastructure position.
Standard rumor mill stuff for a hot company.
Pretty much. But while those rumors are, exciting to speculate on, the underlying risk factors are very, very real. And you really need to consolidate those in your mind before making any investment decision here.
Okay, let's nail down those major risks then. We see maybe 4 big ones. First, just the ongoing significant lack of profitability. They are burning cash very quickly to fuel this growth.
That's number one, for sure.
Second, the heavy dilution and the leverage that resulted from that huge $4 billion in recent capital raises, that overhang is real.
Debt and dilution.
Third, just the sheer execution risk. I mean, actually pulling off the scaling of a global 1 gigawatt data center footprint at this incredibly rapid pace, that's hard. Things can go wrong.
Very hard. Logistically complex.
And the fourth risk?
The fourth risk is more structural, I think. It's their high dependence on the sustained but also volatile AI infrastructure trend itself.
Meaning if the AI boom slows down.
Exactly. If the pace of generative AI adoption maybe slows, or if perhaps some new, more efficient hardware comes along and disrupts the current GPU-centric market, Nebius could get hit extremely hard. Their fortunes are tied to this specific wave.
Right. So this inherent conflict, you've got massive potential upside versus these pretty significant downside risks. That explains why the analyst outlook is all over the place.
Completely. It's quite disparate. You see one consensus price target down around $105.50, which actually implies downside from where the stock is trading now.
Okay, so some are cautious.
But then you see another consensus target much, much higher, somewhere around $156.40, implying massive potential upside still.
That's a huge range. What explains that divergence?
That wide discrepancy, it really hinges entirely on that single question of time we keep coming back to. How quickly can Nebius actually convert this current phase of hyper growth and massive spending into sustained real operational profit?
When does the spending turn into earnings?
That's the billion-dollar question, literally.
Okay, so to try and summarize the overall thesis on Nebius Group then, it seems like it's extremely well positioned. Right at the absolute epicenter of this generative AI boom.
No doubt about its positioning.
Supported fundamentally by that foundational Microsoft deal and just these incredible growth rates we're seeing. So the stocks feels genuinely attractive, potentially, for both traders maybe looking to play those near-term catalysts we mentioned.
Like earnings or the rebalancing.
Right. And also for long-term investors who are really making a bet on structural, multi-year AI infrastructure growth, believing this trend has legs.
It caters to both, potentially, but with very different risk tolerances needed. So look, given the overwhelming growth on one hand and the really heavy investment losses on the other, the question isn't really if Nebius Group is leading in this AI race currently. They clearly are in their niche. It's more about when. When will their path to that projected $1.1 billion in revenue finally lead them to actual sustainable operational profitability? The real question for you, the potential investor, is maybe this. Are you betting primarily on the massive structural AI trend itself, believing Nebius is validating it? Or are you betting more specifically on this particular management team's ability to successfully navigate $4 billion in debt, execute flawlessly, and ultimately avoid some kind of capital crunch down the line? Which analyst target will prove right? That's the bet you're making.